Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Circle.
If you find our talks useful, please consider subscribe, like, and comment underneath. Wait, I need to restart that line. If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we unpack how Mastercard just completely changed the trajectory of global money with today's stock, here's a really useful chart tool for your workflow. Like, if you're looking for a clearer way to read trading charts, the link to VIP Algos is below in the description. VIP Algos is a TradingView indicator suite designed to just, streamline your chart analysis.
Right, which is super helpful.
Yeah, exactly. It features visual buy and sell chart alerts, trend direction tools, automated support and resistance zones, and dedicated take profit and stop loss planning areas. And it is designed to work across a variety of markets, whether you are looking at stocks, crypto, or Forex. Now, it is crucial to remember that VIP Algos is strictly an educational chart analysis tool. It is not financial advice, it absolutely does not place trades for you, and it cannot guarantee profits. Trading always involves risk, so you must do your own research and manage your downside. Because this is an affiliate link, the show may earn a commission if you use it at no extra cost to you.
So to set the stage for what we are analyzing today, there is this massive structural shift unfolding right now in the financial technology sector. And the focal point is Circle trading under the ticker CRCL and their USDC token.
Yeah, it's a huge story right now.
It really is. The massive headline driving the conversation is that Mastercard has just, expanded its global settlement network. They are now officially incorporating Circle's USDC across 8 distinct blockchain networks. And we aren't just talking about obscure test networks here.
No, definitely not.
Right. They're integrating with major Layer 1 and Layer 2 systems. So we're talking Ethereum, Solana, Base, and the XRP ledger.
And that integration, it represents a fundamental shift in the mechanics of how global capital actually moves. Because for years, digital assets have been heavily siloed in the realm of, pure speculation.
Just people trading tokens, right?
Exactly. People trading tokens just hoping the price goes up. But this Mastercard development inserts USDC directly into the traditional financial plumbing. Like when a network like Solana can process transactions in milliseconds for a fraction of a cent, and it's suddenly connected to Mastercard's global merchant network.
Yeah, that changes everything.
It completely bypasses the legacy, multi-day settlement delays of traditional banking.
Which sounds incredible on paper. But here is the core tension, and it's the exact reason this is such a fascinating scenario for you to watch as an investor. You have a company that is rapidly evolving from a niche crypto trading mechanism into the actual core infrastructure of the modern digital economy.
Actual pipes, yeah.
Right. And yet Wall Street has been incredibly harsh on this stock recently. Like, we are seeing massive bleeding price target cuts from major analysts.
Huge cuts.
Yeah, and that creates this intense, almost jarring friction between the booming real-world adoption by payment giants and a stock chart that looks like it's taking on water.
All right, let's move into the wealth building context.
So when you are trying to figure out how a company like Circle fits into a long-term growth portfolio, you really have to zoom out. You have to completely change your framework here.
How so?
Well, you need to strip away the crypto label for a second. This is absolutely not a short-term speculation play. If you are looking for overnight volatility based on internet hype cycles, you are looking in the wrong place entirely.
Right, it's not a meme coin. Exactly. This is a structural play on the modernization of global treasury management.
Right. It's essentially the pipes of the internet's financial system.
Precisely. And the macro tailwinds here are staggering when you look at the raw numbers. The broader stablecoin market capitalization has soared to roughly $320 billion.
$320 billion.
Yeah. Think about the gravity of that number. That is an enormous amount of capital actively seeking a stable dollar-pegged harbor in the digital realm. As a long-term investor, you are looking at a company that is positioning itself to be both the toll booth and the vault for that $320 billion.
And probably trillions more down the line.
Exactly. Trillions more that institutional analysts are projecting will follow over the next decade. It is fundamentally a defensive infrastructure play wrapped inside a high-growth technology sector.
Okay, I hear the structural argument, but let's push back on this thesis for a moment. Because it is very easy to look at that growth and call them the Visa of Web3, right? The foundational network connecting merchants, banks, and consumers digitally.
Right. People love that analogy.
They do. But here's the issue. Visa operates in a highly regulated, globally established legal framework. Are traditional long-term investors jumping the gun by treating a stablecoin issuer as a safe foundational portfolio asset before global regulations are even fully baked?
That's fair.
I mean, it feels like we are looking at a company building a multi-billion-dollar skyscraper. The plumbing might be flawless, that's the technology. The steel might be solid, but Washington hasn't actually issued the zoning permits yet.
Mhm.
If regulatory clarity fails to materialize, the government could theoretically condemn the building.
That is a highly practical concern. And it's exactly why understanding the underlying mechanics of the business model is so critical right now.
Right.
Like, to know if that skyscraper have a foundation that can survive regulatory scrutiny, you have to look under the hood at how the capital actually flows. Now, let's look at the fundamentals.
Yeah, let's get into the actual mechanics of how the money is made, because it's not traditional software as a service.
No, it's not, and the mechanism here is fascinating. To map out their revenue trajectory, you have to look closely at two things: the total circulating supply of USDC and the interest income generated on the reserves backing that supply.
Okay, break that down for us.
Sure, here's how it works mechanically. When an institution or an individual wants to buy USDC, they hand over a real US dollar. In exchange, the company mints a digital token representing that dollar. But that real US dollar doesn't just sit idle in a digital vault.
Right, it gets put to work immediately.
It gets placed into highly liquid, top-tier traditional assets. We're talking primarily short-term US Treasuries and overnight repo agreements. Now, here is the genius of the model.
The float.
Exactly. The company earns the Treasury yield on those tens of billions of dollars in reserves, while the person holding the USDC token holds a digital asset that yields 0%.
Wow.
Right? Because of this dynamic, their balance sheet benefits from an immense, constantly reinvested cash flow. If you have $30 billion earning a 5% yield, you are generating massive revenue with incredibly low overhead.
Which entirely explains the cash flow situation.
Yeah, the free cash flow is remarkably robust. It's a highly capital-efficient machine. And this cash generation is critical because it allows them to fund aggressive research and development without constantly having to go back to the market to raise capital and, dilute existing equity holders.
And they are using that capital to build out entirely new revenue streams, right? Like the most notable being their AI infrastructure to power the agentic economy.
Yes, the agentic economy.
We need to unpack that because agentic economy sounds like pure Silicon Valley buzzword bingo. What does that actually mean for the bottom line?
I know it sounds a bit out there, but think of it as the architecture for machine-to-machine payments. As artificial intelligence becomes more autonomous, AI agents will increasingly need to transact with one another.
Okay, give me an example.
So imagine an AI trading bot or a research algorithm realizing at 2 in the morning on a Sunday that it needs to buy more server space,
Right.
or maybe pay for access to a proprietary data API.
Right.
That AI doesn't have a corporate credit card, and it certainly can't wait for a traditional bank wire to clear on Tuesday morning. It needs a programmable, instant way to settle microtransactions in milliseconds.
And traditional banking rails are physically incapable of handling AI speed transactions.
Exactly. By building the infrastructure to facilitate this, Circle is opening up a massive, high-margin, fee-based transactional revenue stream. But the only reason major institutions will ever trust those rails brings us to their ultimate competitive moat: regulatory licensing and compliance.
The trust factor, the zoning permits from our skyscraper analogy.
You got it. They hold highly coveted U.S. trust and payment licenses. When a giant like Mastercard expands its network, they explicitly state they will only support regulated stablecoins.
So that creates a huge barrier to entry.
Massive.
Yeah.
It forces enormous institutional players like banks and processors like Cross River, Lead Bank, and Nuvei to partner with them because the compliance work is already done. The regulatory moat effectively locks out the offshore, unregulated competitors.
Okay, but let's look at this business model skeptically for a second. If the vast majority of their main revenue is just earning interest on the reserve float-taking deposits, investing them in U.S. Treasuries, and keeping the spread, aren't they basically just a digital, unregulated bank?
Well,
I mean, what happens to this robust cash flow if the Federal Reserve decides to aggressively slash interest rates back to near zero? The fundamental premise of their revenue seems incredibly vulnerable to macro monetary policy that they have absolutely zero control over. That brings us to the catalyst timeline.
And that sensitivity to interest rates is precisely what the market will be scrutinizing as we move into the immediate timeline. We have Q2 2026 earnings projected for late August.
Right, people want to see the numbers.
The market is going to demand hard, undeniable numbers. Analysts will want to see that the actual supply of USDC is growing significantly as a direct result of this Mastercard announcement.
Because volume makes up for lower rates?
Exactly. The thesis is that sheer volume growth can offset the lower yield percentages if rates drop, but they have to prove that volume is actually materializing.
So August is shaping up to be an absolute pressure cooker for the stock.
It really is, and not just because of the earnings report. There is a massive binary event hitting in August, the renewal of their revenue-sharing agreement with Coinbase.
Oh, right.
Right now, Coinbase acts as a massive on-ramp for retail users and holds billions in USDC. Under the current deal, Coinbase gets to keep the interest earned on the USDC held specifically on its platform while sharing broader ecosystem revenue.
So a favorable renewal for Circle secures a massive high-margin cash flow stream and solidifies their most important partnership.
Exactly.
But that sounds like a high-stakes poker game. I mean, Coinbase has a lot of leverage there. And what about the broader horizon? What are the macro catalysts beyond the summer?
So from a macro legislative perspective, the timeline points to the upcoming Genius Act in 2025 and the ongoing development of the Clarity Act.
The regulatory frameworks.
Yes, these are huge federal legislative milestones that aim to establish clear nationwide stablecoin frameworks. And this isn't just about avoiding fines, it's about setting clear capital reserve requirements and auditing standards.
Because once you have that regulatory clarity from Washington, the perceived systemic risk vanishes and the institutional floodgates can truly open.
Precisely. And speaking of institutions, there is a very powerful speculative rumor floating around the sector right now.
Oh, the payment consortium rumor.
Yes. Stripe, Visa, and Mastercard are reportedly very close to launching a joint stablecoin platform, and Coinbase is currently evaluating whether they will participate.
If USDC is selected as the underlying asset for that consortium, it would be a monumental, paradigm-shifting catalyst.
Huge. It perfectly aligns with the broader sector tailwinds. Like the Ripple CEO recently going on record predicting that the overall stablecoin market cap will hit $3 trillion by 2031.
I want to circle back to that Coinbase renewal in August because that is the immediate hurdle right in front of us. If the entire market knows this renewal is coming, isn't a favorable outcome already priced into the stock?
Yeah.
Or worse, is this basically a sword hanging over the valuation? Like, if negotiations break down or Coinbase demands a drastically larger cut of the revenue, does the failure to secure a favorable renewal just completely shatter the current bull thesis?
Now let's pivot to the chart.
Because the chart usually cuts through the narrative and tells the truth about what institutional money actually expects.
Right now, the chart is showing a stock that has absorbed some serious technical damage. We have seen a significant correction from its recent highs.
Yeah, it's been rough.
To give you the specific context on Wall Street's reaction, Mizuho recently initiated a severe downgrade, slashing its price target from $135 all the way down to $85.
A cut from $135 to $85 isn't just a minor adjustment. That is a massive, bleeding haircut. That is Wall Street signaling a fundamental repricing of risk.
It is a severe cut. However, when you look at the current chart structure in tandem with the underlying market narrative, the theme that is starting to emerge is that the risks that define the hold are fading.
Interesting phrasing.
Yeah. The technical implication is that the stock is currently carving out a bottom. The prevailing thesis among technicians is that the Mastercard integration is acting as a fundamental floor under the price.
Like a safety net.
Exactly. It's providing a base of real-world utility ahead of a potential breakout, assuming those new settlement rails actually start generating quantifiable transaction volume.
Let me challenge that floor concept. As we mentioned earlier in the show, tools like the VIP Algos suite can be incredibly helpful for visually identifying where these technical support floors actually sit on a chart. But when you are staring at a target cut of $50 a share, you have to ask yourself a hard question. Is this truly a wall of worry base building scenario where smart money is accumulating? Or are we just staring at a falling knife that simply hasn't hit the ground yet? So what does market sentiment look like?
It is a textbook study in deep market contradictions. On one side, you have the overtly bearish analyst actions, like that Mizuho neutral rating and the severe price target cut we just analyzed.
Right.
The traditional analysts are looking at the immediate uncertainties, like the Coinbase renewal and potential rate cuts, and they are pulling their chips off the table.
But the broader sentiment narrative tells a different story.
It is deeply bullish on the structural side. If you look at retail and independent fundamental analysis, seeking alpha contributors are currently flagging the stock as a strong buy.
Strong buy.
Yeah. They are looking past the short-term earnings noise and focusing entirely on the surging global adoption rates. But perhaps the most important sentiment indicator right now is the overwhelmingly positive institutional flow.
You always have to follow the money.
Always. And traditional finance giants are not just issuing polite press releases, they are actively spending millions to build on the USDC ecosystem.
Daiku.
We are talking about major players like CBW Bank, Cross River, Lead Bank, and Nuvei. They are committing serious capital and engineering resources to integrate these rails into their core operations. The overarching mood among these institutional builders is that USDC is actively winning the stablecoin revolution.
It is a genuinely jarring disconnect. You have the people who rate the stock, the Wall Street analysts, slashing their targets, adjusting their models, and telling everyone to be cautious.
Yeah.
And then on the exact opposite side, you have the people who actually use the product, the major global banks and global payment processors, piling in and building their future infrastructure on top of it.
It's wild.
As an investor, you are forced to consider which group is a better indicator of future value. Do you trust the spectators in the stands or the players actively building on the field?
Yeah, let's talk about the risks.
Because no matter how bullish the long-term institutional adoption looks, the macro risks here are very real, they are immediate, and they have to be weighed.
They do. And the single biggest structural risk goes right back to the vulnerability you brought up earlier, interest rate compression.
Right, the Fed.
Because their top-line revenue is so heavily, deeply reliant on the yield generated from the U.S. Treasuries backing the reserves, any aggressive cycle of rate cuts by the Federal Reserve will directly compress their yield.
Yeah, it's basic math.
Right.
Yeah.
If Treasuries drop from 5% to 3%, that is billions of dollars in lost revenue potential, and it hits their balance sheet instantly.
They are essentially held captive by the Fed's dot plot.
They are. Now, management's mitigation strategy here is scale. The idea is that expanding the supply volume, specifically by pushing massive amounts of new tokens through the new Mastercard settlement network, could offset the lower percentage yield.
Right, if you make less interest per dollar, you need a significantly larger pie of dollars earning that interest.
Exactly. But that volume growth has to materialize incredibly fast to outpace the speed of any potential rate cuts.
And what about the threat of competition?
That is the second major risk. Competitive dilution. It is crucial for investors to note that Mastercard didn't just integrate Circle's USDC and grant them a monopoly. They opened their network to an entire basket of competitors.
Ah, really?
Yeah. Alongside USDC, Mastercard also integrated Ripple's RLUSD, Paxos's PYUSD and USDP, and SOFAS USD.
So the moat isn't exclusive at all. I want to lean into this competition angle because it completely changes the narrative. If every major player gets a regulated, compliant stablecoin approved by the big global payment networks, then the exclusivity vanishes.
I mean, true, but
Think about the streaming wars. Being first was incredible for Netflix. They owned the world, and their valuation reflected a monopoly. But now, everyone has a platform. Disney, HBO, Paramount, Apple. As a result, the margins compress, and the battle for user acquisition becomes incredibly expensive and exhausting.
yeah, the streaming wars were brutal.
Exactly. So does the winner-take-all thesis, which currently justifies Circle's premium valuation, actually hold up if there are 5 perfectly viable, deeply funded alternatives sitting on the exact same Mastercard network?
The streaming analogy is clever, but I'd argue it misses one crucial element: switching costs.
What do you mean?
Well, if you cancel Netflix to watch a show on HBO, nothing breaks. It takes 30 seconds. But if a massive global bank or a payment processor rips out its USDC settlement plumbing to switch to a competitor's token, its entire settlement network halts.
Oh, right, the back-end integration.
Exactly. The engineering cost and compliance friction of changing financial plumbing is monumental. Once USDC is embedded in an institution's back-end, the inertia to keep it there is incredibly powerful, even if alternatives exist.
So with everything on the table, what's the final verdict?
Based on the underlying research, the macroeconomic tailwinds, and the structural trajectory of the business, the final bullish score comes in at an 8 out of 10.
That is a remarkably strong conviction score, especially given the near-term noise and the target cuts.
It reflects the long-term reality of the asset. The research implies a specific evaluation window of 6 to 12 months for this thesis to properly play out.
Okay, 6 to 12 months.
Yeah, that is the necessary time frame required to watch the Mastercard settlement volume actually scale up on the blockchain, and to see the hard data emerge from the Q2 earnings and that massive August Coinbase catalyst window.
So if you had to give the elevator pitch for the long-term investor looking at this today,
The core pitch is that they're the undisputed, regulated leader in the transition to a global digital economy. Yes, the near-term analyst cuts weigh heavily on the stock's current momentum and sentiment. But the deep, verified regulatory moats, the aggressive multi-chain expansion, and the massive potential of a favorable Coinbase renewal set the stage for a potential structural re-rating of the business.
just a quick reminder to everyone listening, this is an analysis of market research, technical trends, and macroeconomic data. It is not financial advice. You always have to weigh these catalysts against your own risk tolerance and portfolio strategy.
Absolutely.
Before we sign off, I want you to think back to that idea of building a multi-billion-dollar skyscraper on an unzoned foundation. As the digital economy rapidly and violently merges with traditional finance, the real question isn't whether the skyscraper will be built. It is whether the regulatory zoning laws will ultimately reward the architect who had the foresight to break ground first. Keep an eye on Washington, because the fundamental blueprint of global money is being rewritten right now, in real time.
Well said.
And if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.